All right, welcome everybody. Mike Alexander here, coming to you live from Houston, Texas, January 30th, 2013. Going to be discussing health, wealth, and lifestyles, a new series of presentations meant to help you manage your wealth in different market cycles. So we're going to be discussing a series of different topics, including financial trust and estate planning, helping you keep more of what's yours, learning about the 5 U.S. tax haven states, helping you learn more about why Nevada may be one of the best states to establish your trust, helping you enhance tax efficiency, control, and asset protection. Also going to be discussing cash flow investing, real estate investing, dividends, businesses, discussing planning topics that will help turbocharge and boost your profits and cash flows moving ahead. Again, all information herein is considered educational and only a matter of opinion, meant to help add clarity around the market cycles. Nothing herein should be considered advice. For that, seek professional guidance and assistance. And I hope that I get to be one of those partners for you, because everybody that's been successful has had a great team, and I am a great team player. Would like to be one of your team players as well. So, getting right into it, Chapter 1, Inflation. Like frogs in a pot of water, it's getting hot in here. I really want to go ahead and discuss real inflation versus government-stated inflation. And also discuss why some goods are going up and some are going down, as there's a lot of confusion around what inflation really is, because high-order capital goods versus low-order capital goods are going up and down. I'm specifically talking about low-order capital goods going up in price. So, Chapter 2, going to be discussing the historical context of market cycles. 13 years into a busted sideways market, do you still have your money in this busting market? I hope not, because I want to help you protect your 401k from becoming a 201k. Most retirees and investors can't afford it. But Chapter 3, 240 to 300 year bond bubble. Fixed income, capital preservation versus purchasing power preservation. I want to add emphasis around the importance of shifting a mindset away from capital preservation of the dollars in your account to purchasing power preservation, because purchasing power preservation means you're going to be able to continue buying the things that you used to, and I want to help you enhance your purchasing power, hence health, wealth, and lifestyles, helping you get ahead and helping you basically provide wealth management solutions for any kind of market cycle. So let's just jump into the CPI, brought to us by John Williams of shadowstats.com. I want you to understand that government-stated inflation excludes food, fuel, energy, gas at the pump, or low-order goods. Those are the necessities, the day-to-day things that people need to survive. Are really excluded from real inflation. Real inflation has been accelerating since the 80s. In 1980, we had runaway inflation that was also around 13.5% to 15%. So most people have seen this movie before. Most people have seen how interest rates have, or how inflation has gotten to this point. So this is a rerun of the 1980 market. And eventually interest rates will go higher, but right now the trend is your friend, and the trend is that things like gas at the pump since 2000 have been going higher and have had impressive price hikes, having been $1 in 2000, now $3.15. If gas were and inflation were only 2 to 3%, it wouldn't be tripling, as the doubling time of money is 7.2% over 10 years. Yet somehow gas has gone up 3 times. Again, I really believe that when it comes to the things that you need day to day, inflation is much more like 10 to 12%. And I want to add clarity around that for most people. So moving forward, the S&P 500 PE ratios. Since 2000, PE ratios have been compressing from 45. PE ratios need to come down back to single digits in the 5 to 10 range. Are we there yet? Well, no. We've been in this red bubble zone above 20 since 2000. Grossly overvalued companies. Most international companies in the 15 to 25 PE ratios. Average S&P 500 today is still in the 13.5 to 45 range. So are we in this buying territory where everything's on sale? No, absolutely not. PE ratios must still come down at least 50% on average. So there are some diamonds in the rough, and there are some companies down there. Most of them are going to be in the natural resource sectors, energy, agriculture, natural resources. Just want to point out that in a sideways market that for retirees that are looking for income, here's a list of 24 results that have great fundamentals. And when you have good fundamentals and good companies, that means you get good appreciation and good income. T&H is an example that I had found back 2 years ago, paying 16% all the way to the bank. Back then it was $100. It's now up. It actually touched 300 and is now around 244. Still paying 16% all the way to the bank. Its PE ratios and fundamentals have drastically changed from where they were. But if you find good companies, you get great appreciation, and that was just a knockout of the ballpark home run, as it doubled, almost tripled in a matter of 2 years. So again, looking forward or looking back, well, that begs the question, where else can you put your money? Or where else should you not put your money? Well, what about bonds? Well, let's talk about bonds. What about them? The impact of rising interest rates. This is a source from Bloomberg. I want to discuss the loss in value from increased interest rate risk in this marketplace, as we've got the biggest or the lowest interest rates we've had in 240 to 300 years. So if you're reaching for yield, you're getting paid a little bit more than you would be if you're in the 5-year note, if you're being quote-unquote more conservative. However, if you reach for more yield, the interest rate risk also goes up. And if you have a 3% interest rate hike, 35.5% loss of principal is what you will witness and experience. And 21.5% if interest rates go up 3% for the 10-year note, 12.5% loss for a 5-year note or a CD. And and this is a rerun again of the 1980s. Hind Sight is 2020. You have the benefit of hindsight today, because in 1980 the Fed funds rate went from 11 almost up to 21.5 by 1981. That means that most people in fixed income aren't going to be cut off at the knees in terms of the loss of principal due to interest rate risk. You're not going to be cut off at the waist. You're going to be cut off at the neck with an executioner's axe or a guillotine. Fixed income assets are really one of the most dangerous asset classes available to investors today. And that goes for cash, annuities, bonds, CDs, really all those. Because if you're looking for shorter duration and less interest rate risk, remember, you're eroding your purchasing power faster and faster each and every year. I want to help shift your mindset to preserve your purchasing power and not your dollars in your bank account, as they will not preserve your purchasing power. It's not what's most important. It's the preservation of your health, wealth, and lifestyles moving forward. So I'm going to give you some tips and tricks, and I want to beg the question, can you have an increase in your stock portfolio while simultaneously losing your purchasing power? And the answer is yes. In '99, the all-time high for the stock market was about 1552, and the S&P 500 has really not gone higher. It's been lower than its all-time high in '99. Today, 2013, the S&P 500 is at 1502. Gas was about $1 again in 2000, and now it's $3. People unknowingly have crashed their purchasing power 66% versus gas at the pump. Even if they doubled their savings at that rate of 7.2% and doubled their savings and investments over the last 10 years, they still purchase 33% less gas at the pump. Inflation is much higher than is stated by the government. And I want to help you benefit from the trend. And the trend is that the necessities, the day-to-day things that people need, low-order capital goods, commodities, are an entire asset class that are going up in price and rising. That's where the trend is. That's going to be where your friend is. And I want to help you benefit by helping you rotate into more of that sector. But how do you measure the purchasing power cycle or the market cycles? I want to welcome you to your new roadmap and help discuss a new topic that you may or may not have been introduced to, but it's something that's called ratio investing. And this is a way of measuring the market cycles, where they start and where they end. And there's the biggest opportunities to benefit from the biggest upsides in these markets, and each time the market started moving sideways, as it did in 2000, we've been 13 years again into a sideways market. The prior cycles took 16 years and 20 years of a sideways bear market. That means that from a historical context, we still likely have 3 to 7 solid years of bear market action. That's a lot of time, because you're going to have a lot of time to still crash your purchasing power unknowingly if you're in some of these unwanted asset classes. And I want to help you take advantage by helping you better position yourself. But in these prior sideways markets where the stocks move sideways, the natural resources and finite resources sectors moved up in purchasing power. Gold is also a natural finite resource. And during these time periods, oftentimes nothing shines brighter than the gold and the precious metals. But I just want to illustrate that in the 29 and the Great Depression era, people had the benefit of increasing their purchasing power ninefold. It took 2 ounces of gold instead of 18 ounces of gold to purchase the same amount of stock. In 1980, it took 1 ounce of gold instead of 28 ounces of gold. That means if you had your savings in gold at the start of the cycle, you increased your purchasing power 28-fold versus stocks. Had you sector rotated here and sold out of your gold, bought more of the Dow, bought more real estate, you would have had a tremendous appreciation by riding the stock market all the way up. And then it was time to sell your stocks again and buy gold again and sector rotate. And again, you've been able to benefit from a tremendous amount of appreciation. And today it takes about 8 ounces of gold to purchase 1 unit of the Dow. And I'm suggesting that it will go back not to 2, not to 1, but to a ½ ounce of gold to purchase 1 unit of the Dow. So that means really that the current price of gold is at $16.50 or so. The Dow is at 13,500 or so. That must go to parity. That means gold will go up all the way up to at least 13,500. And it's likely, though, that the Dow will continue to climb, and people will continue to have more dollars in their accounts. But yet gas and food and fuel at the pump and gold will continue to accelerate upwards faster. What that means is, again, most people will be blindsided, and they'll miss the biggest opportunity of a lifetime, because this is a lifetime opportunity. People will be able to increase their purchasing power 16-fold when compared to the Dow still in this marketplace. So looking at this topic another way, let's compare the median home price versus gold instead of using the Dow. Well, in the 70s to 80s bull market in gold, you had the opportunity to increase your purchasing power 7.2 times versus real estate. Wow. Today, and that's because it took 650 ounces, and at the bottom of or at the top of the bull market, it took only 90 ounces. That was where gold had reached its peak potential. It was time to sector rotate, and this is where it was time to buy more real estate, buy more stocks, buy more of everything to increase your health, wealth, and lifestyles. And again, at the top here in 2000, it was time to really shift into gold out of real estate. As we know, we had a real estate bubble for many of the same reasons we had a real estate bubble back here in the 70s and 60s. But again, now today's median home price takes 180 ounces. Tomorrow, it's likely to take 45 to 90 ounces. That means you're going to be able to buy 2 to 4 times more real estate versus when holding your assets and savings in gold. Now, why does this happen? And it's a very good question and topic I want to seek to answer for you and help add clarity. But in this market, I invest in real estate for cash flow, because in this environment you can easily score 12 to 25% cash on cash return. And with the tax incentives provided in today's market, there is really, in my opinion, not a better way to generate cash. You can't, it's the best way to generate the most amount of income with the least amount of cash. So let's move ahead and discuss why gold and silver can help you retain your purchasing power much better than any other asset class. And give you an example again here, looking at the British pound, the US dollar, the euro. Since 1950, if we're looking at purchasing crude oil, it takes more and more fiat dollars of the world to purchase the same amount of crude oil. And that's because as opposed on the other hand, since 1950, the gold gram and the silver ounce, you notice it's very stable. It's amazingly stable. And that's because gold and silver can help you retain your purchasing power. And in this market environment, they'll help you catapult your purchasing power to untold highs. But when looking at gold currencies, it takes more and more fiat dollars to purchase gold each and every year. And there's a direct relationship between the falling purchasing power of fiat currencies worldwide and inflation and debt in the system. I want you to note that this is a parabolic curve, and it is an exponential curve that is going to be like a hockey stick. And the 90% of this move is still yet to come. But again, gold and silver will continue to reflect the increase in the debt. And that's because there's 202 trillion of unfunded liabilities. Too many baby boomers are turning age 65 or older, 10,000 a day, and they're taking more money out than they're contributing to Social Security and to the stock markets and bond markets. And if you have your money put in the stocks and bond markets and you're not positioned properly, you're going to lose a tremendous amount of purchasing power, because that's where the market is being drained. And speaking of being drained, the purchasing power of dollars worldwide, this is a worldwide phenomenon, where U.S. dollars are, whether you're looking at the U.S. dollar, the Aussie dollar, the Canadian dollar, the Chinese yuan, the Indian rupee, the Japanese yen, all dollars are losing their purchasing power. The Swiss franc, the Great British pound, all those. All dollars are losing their purchasing power each and every year. And really what you should be thinking of this market cycle, or thinking, is that imagine all these as being lifeboats, and they're bobbing up and down in terms of purchasing power, and you have a central banking authority that is making policies that reduce the purchasing power of all of these currencies so as to stimulate more exports and increase exports to the rest of the world. Well, that's what's happening, and the result is that everybody is being drained of their purchasing power. All their lifeboats, everybody's lifeboat, is bobbing up and down on Lake Travis or in the open seas. And all the lifeboats are sinking like the Titanic or the Lusitania. Pick your boat. It doesn't matter. They're all sinking, and they're sinking fast. At an average rate of 15 to 18%. Almost 12%. And when you're looking at silver, this number jumps to 18 to 22%. So silver has much more upside potential, but that means gold has been up 13 years in a row. The other way of looking at this is that your dollars have been crashing and losing 15% value, because gold doesn't really move in price. It's that US dollars buy less food, less fuel, less gas at the pump. And you need to understand that the entire world is facing this problem and challenge, which is why this market still has 90% of the way to go. So looking at a gold-silver blend versus the S&P 500 and the Dow Jones Industrial Average and the NASDAQ since 2000, stocks here looking very flat since 2000, and represented in the green and blue categories here. Again, people have lost 66% purchasing power. Gas has gone up threefold, and gold and silver have gone up about 780%. That means you've increased your purchasing power versus gas 2.5 times. You have an increased purchasing power and are able to do more with your health, wealth, and lifestyles. And I want to help you do that as well. And notice here that even in 2002, most people lost 20%. This was up 43%. In 2008, when most people lost 37%, this was still, gold and silver was up. Actually, gold was up about 6% here, and this past year, gold was up about 7%. It's much more stable. Silver has much more upside potential. If you're more conservative and need to retire, gold is more appropriate. If you have a long-term perspective and want to have maximum growth, silver is going to be hands down your best bet. But where are we at today in today's market? If I had to compare to the 1980s market, we're about here. We're never going to see $15, $23 gold again. It's not likely. It's likely that we have now formed a new bottom. Many people think that we're at all-time highs and a new ceiling, and quite the contrary. It's a new bottom. It's a new floor, and it's likely that we are 2 to 3 years out, but the uncertainty is too great. And if you're not positioned to take advantage and benefit from this market, you will either benefit from a tremendous catapult, or the flip side is, again, looking at this, you will crash your purchasing power so much that it's going to make you cry. And I want you to not cry. I want to help you benefit from this market cycle, because you're going to be able to catapult your purchasing power 16 times more over the Dow. And again, in 1980, you were able to benefit 7.2 times versus real estate and media and homes, 28 times versus the Dow, and 24 times versus the U.S. dollar when priced in gold. But when priced in silver, the story gets a little more exciting for those that want some of that upside potential. And in 1980, the silver $50 high adjusted for inflation was more like $140 in 2013. And again, the upside potential, we're about here. We are 2-3 years, like I said, hopefully, before this catapult begins. And we are likely, again, here, and the silver is going to purchase nearly 45 times more Dow stock between now and 2020, as the historical markets can move sideways for quite a while longer. But silver went up 33 times in the 70s versus dollars, 40 times versus the Dow Jones Industrial Average, 23 times versus real estate. The same fundamentals that pushed it at 33 times up will push silver orders of magnitude higher, as in 1980 it was only the U.S. and Europe that could participate in this market, and the crisis of confidence only affected U.S. and Europe. That was 918 million people sourced from Wikipedia. Today's population is 7 billion people. The market dynamics are so fundamentally different than they were back then. Not only that, imagine the amount of rising middle classes internationally that can participate in this market. The number of people that have an investor's mindset versus the 1980s market, there's got to be 100-fold more people that are going to jump on this bandwagon, and they're all going to be seeking a small sector of the market. Only 1% of the general population purchase the precious metals at this moment, and if that 1% were to simply double their holdings, there would be none available for the rest of the entire world, because the dynamics are such that the amount of supply of silver has collapsed 90%, whereas the amount of population that can participate is increased 8-fold, orders of magnitude higher. So all aboard, sign up now, give me a call. We'll help protect your health, wealth, and lifestyles moving forward, and hopefully enhance it as well. So to discuss and sum up a couple of things here, the fixed income asset class, I want to discuss the risk, reward, safety, liquidity, safest versus riskiest investments today. Going top on down, the riskiest at the top, fixed income bonds, CDs, annuities, preferred stocks are all interest rate sensitive, including cash. Cash, you're going to lose a tremendous amount of purchasing power, just like you have in the last 10 years. You've lost 66% of your purchasing power versus gas at the pump. Let's avoid that. Let's help you get on the trend, help you get on this bull ride, and ride it out so that you can benefit. Using, stocks are going to better hold their purchasing power using energy, agriculture, natural resources. Real estate, not all equal, but can generate better cash flow and better protect your purchasing power. Industrial commodities, again, not equal. Farmland, businesses, again, gold and silver. If you can have good productive assets that are extremely cash flow positive, you're going to be safe. If you can have much better hard assets, nothing's going to shine brighter than gold and silver. So again, the process for me to help you is to help better understand what your unique permanent portfolio allocation target should be by gathering your input and helping you determine how much and how to diversify this portfolio between your need for income, your preference for more proactive money management to avoid those downside risks in 2002 and 2008, and also understand your need for capital preservation and income, and help you create a plan that will enhance your cash flow and reduce your liabilities. And also, at a minimum, 25% of gold and silver. If you're more conservative and closer to retirement, gold is going to be more heavily weighted. I want to help better understand your specific needs and be your partner and team player to help you come out ahead in this market cycles ahead. And when the time comes, help your sector rotate, because the best of technology and innovation is yet to come. And that being said, the last slide I want to share is I want to make sure you're not a victim of the next savings and loan crisis, because bank holidays are to come, and the most vulnerable large U.S. banking institutions and thrifts aren't going to have bailouts forever. And I just used the savings and loans crisis of 1980 because that was really the climax and the change and the tide that created the new market cycle. Because there was a failure of about 747 of the 3,234 savings and loan associations in the United States. Again, sourced from Wikipedia. In 86 to 95, the savings, the federally insured savings and loans institutions declined from 3,234 to 1,645. In a world of PFG Bests, MF Globals, Bernie Stanfords, or Bernie Madoffs and Alan Stanfords, you need to really be wary of the institutions. And again, I've worked at institutions where I tried to be more conservative for clients, give the right advice, but I've always found that profit motives and greed get ahead of fiduciary responsibility to clients. So I want to be your trusted partner and trusted advisor, and not just a salesman that's trying to sell you something. Mike Alexander, coming to you live from Houston, Texas. I really appreciate your time and really look forward to being a resource for you and having an ongoing relationship. Thank you so much. Y'all have a good night.